Investing during a recession, is it a good idea? Well, to begin, in an effort to reduce inflation without sending the economy into a recession, the Federal Reserve has raised interest rates numerous times. However, if you're worried about your investments, especially if you're planning to retire soon, you might be particularly worried about your portfolio. So in this video, I'll be teaching you how to invest during a recession like a boss. During a recession, real estate prices typically drop. As a result, now is a great time to buy real estate while the interest rates and overall package are lower. You can sell them for more money once the economy starts to improve. And keep in mind that pandemics, weaker currencies, and inflation, they're only a temporary global crisis. Real estate properties will surely appreciate in value once we successfully manage this crisis. Because remember, it's about the time you spend in the game of real estate. It's not a short-term bet. So if you're looking at it for long run, you'll win. Dividend stocks. Dividend-paying stocks can be a beneficial addition to a retirement portfolio. Companies regularly pay shareholders dividends as a way to distribute profits, but instead of just looking for stocks that pay a high dividend percentage, I prefer you to invest in dividend growers or stocks with dividend rates that increase quarters after quarters. Especially now that the market is down and interest rates are rising, it would be a great idea to start picking up some good deals out there. But take note, despite low stock prices and deteriorating market sentiment, make sure to keep an eye on high-quality companies only. Defensive stocks. Food and beverages, personal care, healthcare, and utility stocks are all defensive in nature during periods of weaker economic growth and fewer consumer purchases. Why? Well, obviously, regardless of how well or poorly the economy is doing, people still need to eat, brush their teeth, visit the doctors, and heat their homes. Meanwhile, other growth stocks or other businesses expected to grow faster than the market as a whole, however, typically do worse than in a recession. Risky investments such as recent massive run-ups in technology growth stocks will surely underperform during a recession. You have also bonds. Purchasing bonds might be a wise move. Why? First of all, bonds like stocks have had a bad year too, and investors can benefit from paying less for bonds, which returns are typically less volatile than stocks, about 4%. And in addition, bond values typically decrease when interest rates increase, when they typically increase when rates fall. And guess what? A lot of millionaires and billionaires are putting their money in US Treasury bonds for 4% because it's solid and it's an easy way to park their money. However, given that long-term bonds lose value more than short-term bonds do, in an environment where interest rates are rising, it's more reasonable to shorten the duration of your fixed income portfolios. One strategy is to purchase bonds with a shorter maturity period and sell bonds with a longer maturity period. That's what normally people do for about 6 months to a year. Try not to time the market either. The key to investing during a recession and investing in general is to avoid trying to time the market. That's partially because we frequently don't recognize that the economy has entered a recession, unlikely until it's too late. And since stock markets frequently predict economic trends before they actually happen, waiting to sell until a recession has already started and usually result in failing markets. The market has typically already risen if one waits to invest after a recession has ended. But I usually stick to a long-term investment strategy that's in line with my risk tolerance, objective, and timelines. Investing in a variety of things. By keeping diversified portfolios, you can also weather the ups and downs of the stocks and bond markets and accomplish your long-term objectives. A diversified portfolio is one that's included in a variety of investments, including stocks, bonds, crypto, and real estate. The theory is that if one of these areas of your portfolio falls, another could remain stable or even perform well. It's a simple and logical position to hold. You also want to establish an emergency fund. Remember to have enough cash on hand to handle emergencies like losing your job when deciding where to invest your money during a recession. I advise you hold 3 to 6 months worth of expenses in cash, but it's more ideal to have a little bit more if possible, especially when a recession is anticipated, like now. Well, the final word, you just gotta stay calm and stick to your investment strategies. That's what I usually do. So I've been digging the latest news trends, working on videos for hours for you guys, sleepless nights, all to give you the latest happenings that's going on in the investment and real estate market. So if you want to keep up to date, feel free to subscribe, give me a thumbs up, and I'll see you in the next video.